Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, I Tell.
All right. Hey, guys, it's Mark Eitel here, and you are listening to the Mr. Mortgage Show. And, guys, you are in the right place if you want to deep dive the data, go way past the headlines into the real stuff. Get your hands down in there, get them dirty, and walk away with the tips, the tricks, the strategies, the information, and the answers to your questions so you can make better real estate and mortgage decisions for you and your family. If that's you, sit tight because we have an awesome show lined up for you this week. What a great week in mortgage and real estate news. Sometimes this job is difficult because there's not a lot to talk about from week to week. But lately, man, oh man, each week there's been a ton of data, and this was no exception. We started with a big celebration around the CPI numbers, and I'm going to call not so fast on that, but we're going to deep dive that. The CPI number started the celebration this week, and that was followed up by the Fed meeting and the stance on interest rates, his continued pause, and a slight change in the language. Man, what a reaction the market had. We went from pessimism to, on the low end, 3 rate cuts next year, and I've heard as many as 5. And some people are crazy. I definitely want a sip of the cocktail that they're drinking. But guys, I'm not being pessimistic. I'm trying to be a realist. And the call for aggressive rate cuts next year. I know everybody says it's an election year, and I've yet to correlate significant policy change with an election on the Fed side of things. But I'm not saying it can't happen. But what I am saying is sometimes we get a bit overly optimistic and we hear what we want to hear. So one tweak to a portion of the Fed minutes, and all of a sudden we're going to see aggressive rate cuts next year. And I want to be cautious about that, guys, because yes, easing policy is great for all of us because interest rates control so very much. A lot of the inflation is due to interest rates because companies operate on credit lines when they manufacture and they buy and they sell goods, and the interest rate on those credit lines have increased significantly due to the Fed's activity over the last, 12, 18 months. And nobody talks about that. They talk about the direct correlation to credit cards, but they don't talk about all the ancillary effects in the overall economic influence that interest rate hikes have. And then we have a tendency to generalize and assume if the Fed increases or decreases the overnight rate, that's going to have a direct impact on mortgage rates. And it's not. I mean, they're in the same parade. They're marching down the same street, but they dance to different drummers. So we saw that this week, guys. The Fed, his languaging changed, their stance changed. They kept the interest rates where they were. So no change to rates, but we saw mortgage rates pull back on that news and on the anticipation that we might soon be on the other side of this economic event and start to see some policy loosening, if you will. So interesting data around that. Let's back up for a minute to the CPI number, because headlines and the languaging around headlines always drive me crazy. This week was no different. We saw a 3.1 CPI number released, which means things cost 3.1% more this November than they did last November, right? We increased 3.1%. Well, the headline said inflation falls to 3.1%. Well, by definition, inflation can't fall. Inflation is inflating. The elevator is still going up. It's just going up at a slower pace. But here's another place that gets no mention in the headlines. We're 3.1% over last year. What was last year in relation to the year before? The CPI number in November of 2022 was 7.1%. Woo, man, that is scorching inflation. Yes, down from the 9.1 peak, But guys, we're still year over year up over a historically hot inflation cycle. Now, I'm not being a Debbie Downer. I'm not throwing water on the celebration. We're moving in the right direction. But the Fed looks at inflation as one of the key benchmarks when establishing policy, right? He's been very, very clear. His goal is to get that number down to 2%. So 3 over 7 is a much different conversation than inflation falls to 3.1%, because as I mentioned, by definition, it can't fall. And why I'm saying this is, think about a fast moving car going forward. In order for that car to go in reverse, right? And in this analogy, that fast moving car is the Federal Reserve hiking interest rates. So he's been going in this direction at a fairly rapid pace. The goal is to back it up, right? We want that car to back up. Everybody wants rates to come back down. So in order for that to happen, first the car has to go into almost a neutral mode, right? You coast for a second as you take your foot off the accelerator and you're about to apply it to the brake pedal. Well, that's where we've been. We've been in that coasting moment. Maybe there's a tap on the brakes with some of the language changing in the minutes of this week's meeting. But by no means is the car stopped and able to shift into reverse. You can't do it. The car has to decelerate and then stop and then go into reverse. So he can make those moves in anticipation of that. But that's the best analogy I can come up with. So if inflation is one of the key indicators, let's get through this holiday cycle. Let's get through the winter cycle before we start to celebrate and say, ding dong, the witch is dead. All of a sudden inflation is over, because inflation is still here. And I don't know why we take food and fuel out. I mean, I do, but it always frustrates me because food and fuel are what hurts the most in the wallet of a lot of Americans when it costs $70, $80 to fill your tank and $300 or $400 to fill your basket at the grocery store. Man, I grew up in a household. It was my mother, my stepfather, my 3 sisters, and my stepbrother. We were the Brady Bunch. I couldn't imagine what it would cost to feed that household today. Woo, that would be crazy. That household would certainly be listening to the show and wondering where interest rates are going. So with all that being said, guys, the mortgage market did respond wonderfully. And we've seen over the course of the last 4 weeks, in anticipation of all this data, the mortgage rates start to move back a bit. We're much, much closer to 7, and in some cases in the 6s, when not too long ago we were in the 8s. So as I mentioned, different drummers, same parade. So it all is super, super encouraging data. But before you buy into all the TikTokers and all the Instagrammers who are out there dancing, telling you 5 rate cuts next year, a total rate cut of 2.75%. I saw one individual say, man, that's crazy. And I don't see any data supporting that. It's great if you're trying to encourage somebody to buy now and refi next year, but that refi opportunity might be a little bit farther down the road than you think. Ask anybody who bought into that philosophy 18 months ago, 12 months ago, hell, 6 months ago. So there's still great strategies out there. Interest rate buy downs, closing cost contributions, all of that stuff. I'm not suggesting otherwise. I'm just saying don't buy into the hype. It's great news. It's certainly a long time coming. Let's just sit tight and see what this really means for the interest rate environment moving forward. All right, guys, no more Debbie Downer, no more pessimistic Pete, because you hear the music, you know what that means? That is my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. Man, I am wound for sound, highly caffeinated, super excited to be with you today. We data dumped some facts in that first segment, and we are going to dive into any questions that you have today. And if you have questions or comments, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime hotline. And Jen is womaning the hotline, and she will get your questions on the air. If you prefer, just head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Right in the middle of the page is a big orange button that says Get Your Questions on the Air. Just click that button, follow the instructions. Your question will pop up on our end, and Jen will read it on the air for you. Guys, we had an awesome time at the Red Devil Cycles toy run. We did a live broadcast from the Toys for Tots gift collection, all the Harleys, the bands, all of the cool stuff that was out there. We were super, super excited to be a part of that. And we did a recap show. So mixed in with all of the Mr. Mortgage episodes where we do the mortgage show each week is the Red Devil Cycles recap. So if you want to hear the other side of the team, check that out. So anyway, guys, questions are already coming in. I know we covered a lot, but again, I don't want to be pessimistic. I want to be cautiously optimistic, and we're here to answer any of the questions you have around the data we covered, or actually throw anything at me. Give me some music trivia. I'll even give that a shot. But I do know that we've got some questions back there. So let me throw it over to Jen, and we'll get your questions on the air. Hey, Jen, go ahead.
Bella sent this question. I own my company but show losses on my tax returns. So I'm wondering if I can put myself on payroll and pay myself a salary and issue a W-2. Would this help me be classed as an employee?
Hey, Bella, this is a fantastic question, and clearly you've done your homework. Let's back up for a minute for any of the listeners who may not completely grasp where you're going with this, because this is a great, great question. Self-employed borrowers, when you're going full documentation, right? You're fully documenting your income. It requires an evaluation of your tax returns, both business and personal. Now, this is for conventional lending. Yes, there's bank statement programs out there. There's a variety of programs, but for this very reason, if you're trying to get a conventional or FHA or VA or USDA loan, right? Like a normal scenario, you're going to be required to submit those tax returns. Well, Bella clearly has an awesome CPA who beats that number up, and there's not enough income on those tax returns, or in some cases, a loss on those tax returns. So on paper, you're not making any money. Well, the guidelines for employees who get paid via a W-2 is just 2 years of W-2s and the most recent 30 days worth of pay stubs. So Bella, great question. You're super, super creative. You've obviously done some research. Sadly, the answer is no, because you own more than 25% of your business, or assuming that you own. Maybe you own less than 25%, but that's the threshold, guys. If you own more than 25% of the company that you're employed by, you are quote unquote self-employed. And then those tax returns are going to become an issue. So even though you are a W-2 employee of your own company, you're self-employed by that metric. So in most cases, it's not going to work. You're still going to be underwritten as a full-fledged self-employed borrower. This is a great question, and I do get this question from time to time. I do want to encourage you, though, that, and I say this all the time, guys, there are several write-offs that you take as a self-employed individual that can be added back into your tax returns for income calculation purposes only. And a lot of people get frightened by that terminology. They think it's going to require them to refile their returns and then suffer penalties and additional taxes. I'm talking about just taking the tax returns, going through the returns, and looking at some of the deductions and see where those add backs can be applied when underwriting the file. Because a lot of times, guys, the deductions that you take to reduce your income tax can be added back and you can still qualify using those tax returns. So I always recommend first to allow us to do a self-employed income analysis where the calculations are actually run through the underwriting and we say, okay, this is the monthly income number based on these tax returns. If we can approve you with that number, you're good to go. You are quote unquote fully documented income, which will give you the best interest rate, the best program, the best down payment options available. Then from there, you can start backing up and having additional strategies. Maybe there's a 1-year tax return program. Maybe there's a bank statement program that requires only 1 year or 2 years. So we start that hierarchy of down payment, interest rates, and we work backwards from there to see if there are additional programs available. But again, Bella, great question. You get the creative question of the day. I'm going to throw that out there at the very start of the show, the first question, because clearly you've thought this through and you see that the guidelines for a W-2 employee are different. So I just want to thank you for that one. We don't get a chance to talk about it, but guys, 25% ownership is the threshold where you are then going to be treated as self-employed. So I hope that helps somebody out there. I did want to deep dive that just a little bit to give you some context and possibly get your wheels turning. So, hey, here's an analogy that might help. I use this one a lot. So the perfect mortgage application is like a stool or a chair. I like stool for some reason with 4 legs, right? And those 4 legs consist of your income, your assets, your credit, and the 4th leg is the property, right? The property's appraises, it's in good shape, the whole 9 yards. So you've got 4 legs. If you have all 4 of those legs, you've got a wonderful likelihood of this being a smooth process and you getting approved without an issue. But we all know a 3-legged stool will stand. I don't know that I want to jump up on that 3-legged stool and change the light bulb. It's not as solid as that 4-legged stool, but it'll stand. So if you have the assets and the credit report in the property, but the income documentation is a challenge, well, there might be a loan program that'll work, the bank statement loan. There are even some no income loans. There are a lot of other criteria that have to be met, but my point is 3 of those legs can often get you a standing stool. If your credit is not as good, but you've got great income and great assets, you're likely able to overcome the credit issue. So I'm saying all that just to encourage you to start the process. Let somebody do the self-employed income analysis for you based on your tax returns. And that'll let you know if that leg of the stool is there. Because if it is, then you might be off and running. So great question. I appreciate that one. Anytime I get to use one of my crazy analogies, I appreciate it. Hey guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And friends, we are so glad that you're with us today. We've covered a lot, but we've got a lot more to get to. And if you want to be a part of it, just call or text your questions to Jen. She is womanning the Anytime Hotline, and that Anytime Hotline number is 855 855-462-7292. Again, that's 855-462-7292. You can call or text the Anytime hotline or head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Right in the middle of the page, right under my ugly mug, is a big orange button that says get your questions on the air. If you click that button and follow the instructions, your questions will pop up on the screen and Jen will read them on the air for you. But guys, let's keep it rolling. We just talked about self-employed borrowers and the often overlooked opportunity around getting that self-employed income analysis done, because you might be surprised to realize how much your income will increase once those add backs are attributed to it. So, and keep in mind, guys, has nothing to do with refiling your tax returns. It's just an income verification underwriting guideline that allows some of those write-offs to be added back. But let's keep the party rolling. Hey, Jen, do you have another question?
Donna emailed us. I've seen several headlines saying rates have come down recently, but my bank says the HELOC rates are still the same. Does this seem right?
Hey, that was Donna. Great question. We kind of alluded to that in the opening segment, right? That we're talking about mortgage rates and the prime rate, if you will. Every time he raises or cuts rates, that number goes up or down accordingly. And that's what you're going to see moving forward, right? Mortgage rates have fallen, but the Federal Reserve has not started cutting interest rates, and there's debate when or if that's going to happen. As I mentioned, we talked about that. So until they start cutting, you're not going to see things like home equity lines of credit or business lines of credit or the credit cards come back down, those interest rates. So just keep that in mind. Mortgage rates and adjustable rate consumer debt, which a HELOC is typically classed as, will move in different sequences at different times for often different reasons. So your bank is not wrong. We have not seen downward adjustments on home equity lines of credit. And that's an interesting conversation, because if you're taking a home equity line of credit to pay off a bunch of high interest rate debt, and that interest rate that you're getting from the bank on your HELOC is no longer attractive, check out the rec refi. That's the purpose of that loan. Reduce, eliminate, and consolidate your payments so you can pay some things off and reduce your monthly payments by consolidating it together. And it doesn't always work, guys. Sometimes you just have too much consumer debt. But a debt consolidation refi, or the rec refi, is often a great strategy just to give yourself a little bit of relief each month when you're trying, or in some cases, a lot of relief if you're, drowning in debt, if you will, and you've been waiting on the Fed. Because as I mentioned, that moving car doesn't slam into reverse, and it rarely backs up as fast as it's been going in the forward direction. So I don't think the Fed is going to undo everything that he's done, and certainly not anytime soon. So check out RECREFI.com. If there's any interest or you have questions, just call or text us. I'll be happy to walk you through it. But that rec refi might be an option if that's the case. So the other place we're seeing a lot of interest in equity lines right now is pulling some of that equity out of your property and then using it to go buy an investment property. We talk a lot about a variety of strategies around buying an investment property, and one of them is to extract some equity. And the bank's always the best place to start for an equity line. I know there are a lot of mortgage brokerages out there on TikTok and Facebook talking about it, but the bank oftentimes has the lowest interest rate and the lowest fees to originate an equity line. But great question. Hey, Jen, throw me another one.
Nick sent this text. What is the down payment requirement for the landlord loan? Does it change based on the property? We're looking at a fourplex.
Hey, Nick, this is a great question. The landlord loan down payment from a single unit to a 4-unit is the same. Sometimes if you get over the 4-unit, the guidelines will change. But right now, today, you can count on putting between 20 and 25% down. In the height of the craziness, you could get away with as little as 15%, but plan on 25, worst case scenario. And then if the property cash flows you don't need to disclose personal income, which is a big, big plus for a lot of people with that landlord loan. So 25% down payment. If the rental income supports the carrying costs, principal, interest, taxes, and insurance on the property, then it pencils and it's a fundable deal. So assuming that you've got the credit and the assets, because you will have to have some reserves, you're good to go. But great question. I appreciate that. And anybody who's out there thinking about buying investment property, we've got a strategy in place where parents are buying investment properties with the intent to sell them to their children later because they've seen this rapid appreciation cycle, and their fear is their kids are never going to be able to buy a house because of where prices and rates have gone to. So they're thinking, hey, I can pull some equity out of my house. My kid is 15. I'll put a tenant in there. In 10 years, when he's finished with school or she's finished with school, I can sell them the property with a gift of equity. And basically, you're putting their first home on layaway. And we even call it that. We call it the first home layaway program. Because, guys, you know I have to name everything. Sometimes it's cheesy, but I have to name everything. So an equity line is a great jumping off point for something like that. But brilliant question. Hey, Jen, can we squeeze in another?
Jared emailed this one. We're selling our home without a real estate agent. We're getting offers, but how do I know if the buyer is approved for a mortgage? What should I ask?
Hey, Jared, this is a great question. But before I answer it, clearly you do not have the book, because if you had the book, you would know the answer. Guys, before I answer this question, if anybody out there is thinking of braving the for sale by owner and you don't want to end up wondering how you evaluate an offer or at least an approval that's accompanying an offer, check out FSBOZILLA.com. That's FSBOZILLA. I love that name. Again, guys, I got to name everything, and sometimes they're corny, but we wrote a book and 4 how-to guides designed specifically for people who are trying to brave the waters and do it themselves. And guys, I get it, right? You're trying to do the very, very best for you and your family and extract as much profit out of that asset as you can. I commend you. And that's why we designed the program. Guys, there's no cost, there's no fees, there's no catch. Check it out. You can download the book. It all speaks for itself. FSBOZILLA.com. Now, Jared, back to your question. After the PSA, now I get to answer your question. So you're going to want to request the pre-approval from the lender or mortgage brokerage that the buyer or proposed buyer is using for their financing. And in that approval, there are some key things you want to look at. You want to look at the interest rate that they're approved for and check it against the market rate. Because if somebody's approved with a 5% interest rate and market rate is 7%, well, they're probably not approved today. So check the interest rate against market. That's the first thing. The second thing is depending on how detailed the approval is. Well, let's hold that off to the third thing. The second thing is look at the loan program type and make sure it's compatible with your property. If you're selling a condo and somebody's presenting you an FHA approval, that might not fly only because not all condo associations are approved. And then lastly, I would make sure it's an approval and not a pre-qualification, because the approval will have required some verification of documents. And then if you get a bona fide AUS approval to look at, call me and I'll walk you through it, because it's complex and there are a couple of key things you can look for to ensure that it's a rock solid approval. Thanks for that question, Jared. Hey guys, you hear the music. You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very, very short break. We'll be back with more of the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and this is the Mr. Mortgage Show. And you heard the man. If you have questions, you can call or text 855-462-7292. That's 855-462-7292, affectionately known as the Anytime Hotline. Jen is womanning the hotline, and she will make sure your questions hit the airwaves. Or if you prefer, you can head over to MrMortgageRadio.com. That's MrMortgageRadio.com. And right in the middle of the page is a big orange button that says Get Your Questions on the Air. Just click that button, follow the instructions, and Jen will read your question on the air for you. But hey, speaking of Jen and speaking of your questions, I know we've got a couple over there, so let me throw it her way. Hey, go ahead, Jen.
Walter has this question. Is there a maximum loan amount for a reverse mortgage? We own our home outright, and it's worth approximately $3 million. We'd like a $1.5 million loan.
So, Walter, this is a great question and very, very timely because there are a lot of headlines about the recent loan limit increases from the FHA for the reverse mortgage product. Now, it's a little bit deceiving because the loan limit on this program has been increased to $1,148,000. But here's the thing. That's the maximum amount that FHA will insure for the reverse mortgage. Now, keep in mind that the reverse mortgage balance typically grows. Your obligation is going to increase because it doesn't require a monthly payment. So unlike a typical mortgage, when you see the loan limit, you can borrow up to that loan limit because you're then paying it down. With a reverse mortgage, your projected remaining lifespan, which is calculated on a mortality table based on your age, where you live, all of that goes into the underwriting guidelines. The interest rate, the value of the property, you've got plenty of value for this to work, but the challenge is you can't borrow $1,148,000 because next month you're going to owe more than that, and the loan has exceeded the limit. So you're likely to get far, far less. Again, you're in a unique situation because you've got a load of equity, right? You've got $3 million in equity. So the equity in the property is likely to protect the investment, but the FHA loan limit guideline is going to be exceeded. Even though the equity protects the investor, it's going to exceed the insurable loan amount that FHA has for HECM refis. So usually in an environment of $1 million max loan, they might be comfortable with a $500,000 loan amount because they're going to forecast over time for that loan amount to grow. So, Walter, I hope that helps, and I'd love to encourage a conversation. Connect with us off the air and let me get a better understanding of your goals, and I can take some time to explain exactly how the program works and where you're hitting the limitation. If you choose, call me because I'd love to chat with you. If not, if this makes sense, fantastic. But if it sparked a question for anybody out there, connect with us and I'll be happy to help if I can. Great question, Walter. Thank you, sir. Hey, Jen, throw me another one.
Shelley used the website. I'm getting divorced and want to buy my own house. Do I have to wait until we're officially divorced? I'm asking from the mortgage standpoint since we own our current home together.
Okay, now I think I understand. At first I was a little confused, but I let Jen finish the question because, complete data in, oftentimes you get a better result. If I'm understanding it correctly, your question is around the fact that you currently have a primary home that you own with your husband, soon to be ex-husband, and you want to purchase another primary home. So I've got a ton of questions. Who's going to end up with the current home? Because if he's going to end up with the current home, then my strong suggestion is that part of the divorce decree or divorce settlement agreement has him refinancing the property solely into his name. I say it all the time. Quitclaim deeds are fast, they're easy, but if you own the debt, you should also own the asset. So if the divorce decree is allowing him to take over the property, he should refinance the property into his name so that you're no longer on the debt nor on the asset. Now, to answer your question, Usually in this circumstance, there's a 1 or 2 page document that the attorney can draft that will allow you to purchase a primary residence now, but he'll have to waive his marital right to that property. Assuming everybody's playing nicely and he'll sign the document, there's typically a 1 or 2 page document, depending on if your attorney charges by the word, that will allow him to waive his right to that property, which will then allow you, assuming you qualify, for the primary purchase now. And a lot of people do this because it's easier to get divorced if you're already separated versus fighting every night under the same roof. So I hope that helps. This is a common question in this circumstance, and we've seen it accomplished often with this 1-page document. So if you need any further information around that, just connect with us. I'll be happy to help any way that I can. Hey, Jen, throw me another one.
Julio called this one in. I'm retired and just my pension and Social Security. I have some cash and would like to buy a rental property. Will my lack of income be a problem?
Me and Julio down by the schoolyard. It's been weeks since I've tried to work a song into an answer. That was the best I could come up with. Who was that, by the way? Me and Julio down by the schoolyard. Was that Simon and Garfunkel? I don't remember. Guys, I'm not that old. I'm not Simon and Garfunkel old, but my mom did have a pretty cool record collection, and I heard some interesting music growing up as a kid. Anyway, this is a great question. This is why the landlord loan is such a popular program, because it has nothing to do with your income. You'll credit qualify based on your credit score and your assets, but if the income from the property supports the debt, you're good to go. And this works for anybody, guys. If the income from the property covers the principal, the interest, the taxes, and insurance, and if there's an association, it's considered cash flow positive. So assuming you have the assets and the credit score required for the program, your income is a non-issue. Great for self-employed people. Great for closing in the name of an LLC. Great for an individual or an LLC who owns multiple properties. Great for somebody who just doesn't want to, or in this case, because you're retired, can't document adequate income to support that additional debt. Guys, the landlord loan is a great, great loan program where we're leaning on the income generated from the property to support the debt. If it pencils, you're good to go. Great, great question. Hey, Jen, can we squeeze in one more?
Angie has this question. My dad told me to get 3 mortgage quotes. I have them, but I'm not sure what I'm looking at. What should I be looking for to make sure there are no hidden fees or surprises?
Guys, this is a great question. So I would look at the interest rate. I would look at the loan origination or broker fee section to see what you're paying for that interest rate. And then this is a big one, guys. I would look at the monthly payment, but more importantly, the monthly payment breakdown. Make sure they're quoting a real number for taxes and a real number for insurance, because if you're just glancing at these and you're choosing based on payment alone, which is how 99% of purchase decisions are made. Hey, why is this payment lower than the other? I don't know. They had the best payment. Boom, I'm going that route. If those taxes and insurance weren't adequately disclosed, that payment could be deceptively low, and it's going to be adjusted upward prior to closing because it's going to be based on the real number, the real insurance number and the real tax number. And that information is easy to get, guys. If you need help with this, call or text, go to MrMortgageRadio.com, click on the fee sheet review button. It's free. It's easy. We'll look at all 3 of them for you and point out where you might be able to negotiate a better deal, or point out the one that's already given you a great deal, or maybe we can give you yet a better deal. So check out MrMortgageRadio.com and click that fee sheet review button. But look at those 3 places: broker fees, interest rate, and look at that monthly payment breakdown. It's easy to be deceiving around there. I would also look at the interest rate versus the APR because that will give you an indication of the amount of fees that you're paying. But man, here comes the music right when I was getting my a full sail of wind here. Guys, you hear the music, you know what that means. We have wrapped up another episode of the Mr. Mortgage Show. If you need us when we're not on the air, head over to MrMortgageRadio.com. All the stuff we've talked about today is there. All of the links and the buttons and the cool features, the mortgage rates, MrMortgageRadio.com. One more time for the kids in the back. Check out MrMortgageRadio.com. All right, guys. Jen and I will be back next week right here. Same time, same station. Have an awesome week.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.